Hi, my name is Lauren Kimble, and today I'll be discussing my findings from my financial analysis of 15 companies from 3 different industries over 5 years. After analyzing each industry, I chose which company I thought was the best, which one I would want to invest in. And so in this presentation, I will show which companies I chose and explain why I chose them. And then for my top 3, I will pick one overall best company and explain why I chose that one. The first industry that I chose to analyze was the retail industry, and the 5 companies that I chose for this were Walmart, Target, Costco, Publix, and Whole Foods. The company that I thought would be the best for this industry was Whole Foods Market. So now I'll get into the ratios that I looked at and explained how I came to the conclusion that Whole Foods was the best. When analyzing each industry, I started with the current, quick, and cash ratios just to look at how the industries are doing in the short run. These ratios explain how much current assets each company has to cover their current liabilities. As you can see, the retail industry as a whole is generally not very liquid. I was surprised to see that big companies like Target and Walmart are the least liquid. Walmart, even if they were to liquidate all of their current assets, would still not be able to cover their current liabilities. But Whole Foods, a significantly smaller company in size and sales, is much more liquid. They have 94 cents of cash for every dollar of current liabilities. So they're still not completely liquid, but they are substantially better than all the other companies of the industry. So next I looked at the long-term solvency of each company within the industry. I did this by looking at how much debt financing they had compared to how able they were to pay off the interest expense on this debt. So as you can see by looking at the equity multipliers, the retail industry is not in general taking on that much debt. But the companies that are engaging in leverage are also very capable of paying back the interest expense that they owe. Publix and Whole Foods, however, they do not have a cash coverage ratio because they are not paying any interest expense because they have so little debt. So next I looked at the return on equity ratio to look at the profitability of each company. This ratio shows how much in net income each company is earning for what the stockholders have invested in the company. As you can see, Walmart has the highest ROE, while Whole Foods has the lowest, leaving Costco, Publix, and Target in the middle with average return on equities. I then did a DuPont analysis to look at what was driving the return on equity ratios. This analysis breaks down the return on equity into profitability, asset efficiency, and financial leverage ratios. The first thing that I noticed when looking at this breakdown was that the tax burden for each company was within 62 and 67%, which means that they were paying about 35% in tax expense, which is fairly normal. And these numbers were also consistent for each company throughout the 5 years. So I determined that the tax burden does not have much effect on their return on equity ratio. So I moved on to some other ratios. And if you look at the interest burden, you can see that there's not too much of a range between these numbers. The lowest interest burden is Target, paying 12% in interest expenses. Publix and Whole Foods, their interest burdens are higher than 1 because as I mentioned earlier, they are not paying an interest expense because they have such little debt. So I moved on to some other ratios, and you can see at Costco, they have the lowest operating margin, which means that they're keeping the least amount of money from their sales. However, if you look at their total asset turnover, they are selling the most out of all the companies in the industry. So this kind of gives them an average return on equity. Well, Publix and Target have the opposite problem with very high operating margins but very low total asset turnovers. So then we move to Walmart, who has fairly average numbers across the board, but they also have a fairly high equity multiplier, and this debt is what's kind of driving up their return on equity ratio. Then we have Whole Foods, who does not have the highest operating margin, but it's still a pretty high number, and they have a total asset turnover that is only second best to Costco. And so this is why their return on equity ratio is fairly low, but it's still a good number. It's only as low as it is because they are not as highly leveraged as most of the other companies are. So then after looking at what was driving the return on equity numbers, I wanted to look at how the return on equity had grown over the last 5 years for each company. And as you can see, Whole Foods' return on equity has grown the most in the last 5 years at 89.3%, and it grew every year. Costco also had this constant growth, but not as high of a growth rate. And then Publix and Target and Walmart, their return on equity kind of jumped around each year. So the main reason why I chose Whole Foods as my best company is because they were constantly growing each year, but they were doing so without taking on extra debt. So next I looked at the market value ratios for each company. I looked at their price to earnings, economic value, and their return on invested capital. The price to earnings for Target and Walmart, which are the biggest companies with the highest return on equity, are actually the lowest PE ratios, which means that their future earnings are worth the least out of all the companies from this industry. And then Whole Foods has the highest PE ratio because the marketplace has seen the growth that they've had over the last few years, and they're expecting more of the same from them in the future. So I looked at the economic value added for each company. And as you can see, Walmart clearly has the highest EVA with almost $8 billion of economic value added. And then there are companies such as Costco and Target who are actually not making as much money as they're supposed to be for their company. And then we have Whole Foods that it has $142.67 million of economic value being added to their company. And then I looked at the return on invested capital for each company. This ratio shows how much of the invested money in the company is being kept in net operating profits after taxes. As you can see, Whole Foods is just behind Publix at 13.48%. So that sums up the results of my retail industry. So now we'll move on to the next industry, which is the telecom carrier industry. And the 5 companies that I chose for them is Verizon, Windstream, AT&T, T-Mobile, and CenturyLink. The company that I thought would be the best for this industry was AT&T. So now I'll get into why I came to that conclusion again. I looked once again at the liquidity ratios, and as you can see, there's either very high ratios or very low ratios for this industry. There's not a whole lot of in between. T-Mobile and Verizon are very liquid considering the rest of the industry. If they were to liquidate any of their assets, they would be able to cover all of their current liabilities. But as you can see, the rest of the companies, if they were to liquidate all their assets, they would not be able to cover their current liabilities. So next we have long-term solvency ratios again. And as you can see by looking at the equity multiplier, there is a wide range of numbers of debt financing for this industry. However, all of these companies are still very capable of paying off their interest expenses if you look at the cash coverage ratio. Verizon has a fairly high equity multiplier, but they also have the highest cash coverage ratio. Windstream, however, has the highest equity multiplier but the lowest cash coverage. They are not doing nearly as well as the other companies. And then AT&T has a very low equity multiplier, but they also still have a high cash coverage ratio. So they're doing very well for long term, and they have room to grow with debt if they need to. Next, I looked at the return on equity ratio again to look at the profitability of each company. And as you can see, once again here, there's a very wide range of numbers ranging from negative 1% to positive 32%. CenturyLink and T-Mobile are the two companies that are less than 1%, while the other companies are significantly higher and doing very well. So I once again did DuPont analysis to look at what was driving these return on equity numbers. And the first thing that I noticed was that the total asset turnover for every company in the industry was very low. These numbers range from about 0.3 to 0.8, and they are consistent for each company over all 5 years, which makes sense because this is a service industry and they're not selling inventory such as the retail industry. So I determined that this total asset turnover number does not significantly affect the return on equity for these companies. So next, looking at CenturyLink, they have that negative 1.31% return on equity because of their negative tax burden. This negative tax burden means that they are paying more in in tax expenses than they have in earnings before taxes. And coupled with all their other very low numbers, they have a negative 131. And then we look at T-Mobile, and they just have low numbers across the entire ROE breakdown, which leaves them with only a 0.4% return on equity. And then Windstream, they have as high of a return on equity as they do because of their extremely high equity multiplier. The rest of their numbers are not very good, so it is just that high debt that is driving their return on equity up. And then AT&T and Verizon, they both have fairly high operating margins. However, Verizon's return on equity is so much higher because they have more than twice as much debt as AT&T has. So then I once again wanted to look at the return on equity for each company over the 5 years. As you can see, CenturyLink, Verizon, and Windstream have had fairly consistent and very significant losses over the last 5 years. This means that AT&T and Verizon are the only two companies that have even grown their return on equity in the last 5 years. Verizon has grown theirs more so than AT&T, but AT&T is a slightly more consistent growth than Verizon. So next we have the market value ratios for the companies of this industry. As you can see, there's once again a very wide range of numbers between the companies. And at this point, I'm really choosing between AT&T and Verizon because, as you've seen on the previous slides, they are significantly better off than the rest of the companies of this industry. And if you compare them to each other, they both have significant advantages and disadvantages, such as AT&T is not very liquid while they are significantly less leveraged than Verizon. So it's really these market value numbers that kind of help me make my decision for this industry. If you look at the economic value added, Verizon is not making $8 billion that they are supposed to be making, while AT&T is earning $8 billion of economic value added for their company. And AT&T also has about 850% more of their invested capital being retained in their net operating profits after taxes than Verizon does. So that is why I chose AT&T over Verizon and the rest of the companies in this industry. So that about sums up my second industry. So now we'll move on to my third and last industry, the gaming industry. And for the 5 companies for this industry are MGM, Boyd, Isle, Penn, and Pinnacle. And the company that I chose as the best for this industry was MGM Resorts. So now I'll go through the ratios again and explain why I chose MGM for this industry. And I once again started with the liquidity ratios. And you can see, looking across the board, this entire industry is not very liquid. None of the companies have a cash ratio that's over 1. And so looking at MGM, you can see that they have the highest cash ratio, but it's still not over 1. They're not completely liquid. They only have about 81 cents of cash for every dollar of current liabilities. And so now moving on to the long-term solvency, we look again at the equity multiplier and cash coverage ratios for the industry. And you can see that Boyd, the company with the highest amount of debt, also has the lowest cash coverage ratio, so they're the least likely to be able to pay back the interest they owe on this debt. And then Penn has the lowest amount of debt, but yet the highest cash coverage ratio. And then we have MGM in the middle with their amount of debt, but they also have kind of a low cash coverage ratio, but it's still enough for them to be able to pay back their interest expenses that they owe on the debt that they have. So now I look at the return on equity to get an idea of the profitability of all of these companies, but as you can see, they all have a negative return on equity. And so I was wondering how they got these numbers. MGM has the highest negative return on equity at negative 3.64%, and this just means that they're losing the least amount of money for their company out of all the companies in the industry. And so the DuPont analysis shows where these negative numbers are coming from. And the first thing that I noticed for this industry was, once again, just like the telecom industry, is that the total asset turnover is very low for all of these companies, ranges from about 0.3 to 0.8. And it makes sense, once again, because this is a service industry. They're not selling inventory or other assets like the retail industry does. And so I once again determined that these numbers are not going to have much of an effect on the return on equity for the companies of this industry. And I also thought that the operating margin for this industry, there's not much of a difference between the operating margins. There is a bit of a variation, but I feel like the return on equity numbers are being driven more so by other ratios. So they're all relatively high for the companies of this industry, so their operations are running well. So I like to look at what it is that's making their return on equity low, if it's not this operating margin or total asset turnover. So as you can see, the four companies, Boyd, Isle, Penn, and Pinnacle, all have a negative return on equity due to a negative interest burden. And this negative interest burden means that they are paying more in interest expenses than they have in earnings before interest and taxes. And all of these companies have such high negative return on equities because this negative interest burden is also coupled with a very high equity multiplier, except for Penn, whose interest burden is substantially high enough on its own to raise that return on equity because they don't have that high equity multiplier. And then we have MGM that has this negative return on equity due to a negative tax burden rather than interest burden, such as other companies. And this negative tax burden means they're paying more in tax expense than they have in earnings before taxes. And so this, coupled with a higher interest burden and lower equity multiplier, means that they only have a negative 3.64% rather than the much higher negative numbers of the other companies. And so then I went to, again, look at the return on equity over the 5 years, and we see that MGM is the only company that has actually increased their return on equity in the 5-year span. Although, even though they have increased their number, they have gone up and down each year. All of these companies have, and so really next year they could, any of them, drastically increase or decrease. There is no pattern of growth for any of these companies. So next we look at the market value numbers, and as you can see, most of these companies don't even have a price to earnings ratio, and most of them have a negative economic value added. But we see MGM is the only one that has a positive economic value added of about $524 million, and they also have about 11% of their invested capital being retained in their net operating profits after taxes. So this concludes why I chose MGM as my top pick for the gaming industry. And now I will discuss which company I chose as my overall top pick. And that company is Whole Foods Market. When making this decision, I did not really consider MGM as an option because even though they are doing the best out of their industry, they're still not actually doing well. They have a negative return on equity, and the company and the industry as a whole just does not have a pattern of growth, and I would not think it to be a wise investment decision. And so that really left me with AT&T and Whole Foods, and I did not choose AT&T for a couple of reasons. The first being that they do not handle their current assets very well. If something major were to suddenly happen, they would probably have a difficult time handling that situation. And they also even though they do have a high return on equity, and it has grown over the last couple of years, it's not been a very consistent growth. And I just noticed that industry has had a lot of decreases in their returns. And so I chose Whole Foods because they have had consistent growth over the 5 years, and they also are handling their current assets very well, so they could handle any sudden changes probably a lot better than some of the other companies. And they've been able to do all of this without having to take on any additional debt. And so I also think that the retail industry in general is just more reliable and has had more consistent earnings and growth than the rest of the industries. So that was my financial analysis. Thank you for listening and have a great day.